Welcome back to Cashegories, your go-to channel for in-depth discussions on finance, economics, and the stories that impact us all. Today we're diving into a pressing issue that could have significant ramifications for Californians, especially homeowners. We're talking about State Farm's ultimatum to California Governor Gavin Newsom. They've made it clear. Either they get to hike up their rates, or they might have to pack up and leave the Golden State. But how did we get here? And what does this mean for you? Let's break it all down. Recently, State Farm, one of the largest insurance providers in the United States, issued a stark warning to Governor Gavin Newsom. They claim that due to rising operational costs and stringent state regulations, they can no longer afford to operate in California unless they are permitted to increase their insurance rates. A representative from State Farm stated, "Without the ability to adjust rates to reflect the true risk and cost of doing business, continuing our operations in California is unsustainable." But what exactly are these operational costs? And why is State Farm feeling the pinch now? Let's break it down. Operating costs for an insurance company include a range of factors such as payouts for claims, administrative costs, marketing, and legal fees. However, in California, the costs associated with natural disasters have become a significant burden. Operational costs can be categorized into several main areas. 1. Claims payouts, payments made to policyholders for covered losses. 2. Administrative costs, expenses related to running the business, including salaries, rent, and utilities. 3. Marketing and sales, costs to acquire new customers and retain existing ones. 4. Legal fees, expenses for legal services including litigation and regulatory compliance. Among these, claims payouts have been particularly problematic in California due to the state's high exposure to natural disasters. To understand the current situation, we need to take a step back and look at the history of insurance regulations in California. In 1988, California voters passed Proposition 103, which fundamentally changed the way insurance companies could operate in the state. Proposition 103 requires insurers to get approval from the California Department of Insurance before they can change their rates. The goal was to protect consumers from exorbitant rate increases and ensure that insurance remained affordable. However, this also meant that insurance companies had less flexibility to adjust their rates in response to market conditions. Over the years, these regulations have been both praised and criticized. On one hand, they've prevented sudden, steep rate hikes. On the other hand, insurers argue that it has made it difficult for them to remain profitable, especially in the face of increasing costs. Proposition 103 was a direct response to the public's outcry over high insurance rates in the 1980s. It mandated rate rollbacks and refunds to consumers, and established the California Department of Insurance as an elected position, accountable to voters. It also allowed consumer advocacy groups to challenge rate increases, giving more power to the people. Initially, Proposition 103 had a significant impact. Insurance rates were rolled back by 20%, and consumers received substantial refunds. However, over the decades, the effectiveness of these regulations in balancing consumer protection and market sustainability has come into question. California is no stranger to natural disasters. Wildfires, earthquakes, and floods are a part of life here. These events have a massive impact on insurance companies, leading to significant payouts. According to recent data, the costs associated with natural disasters have skyrocketed. For instance, the 2018 Camp Fire alone resulted in insured losses of over $12 billion. With these rising costs, insurance companies like State Farm argue that they need to increase their rates to cover the higher risks and maintain their financial stability. Let's take a closer look at some of these events. The Camp Fire in 2018 was the deadliest and most destructive wildfire in California's history. It destroyed more than 18,000 structures and claimed 85 lives. The financial toll on insurance companies was enormous, with billions in claims filed. And it's not just the Camp Fire. In 2017, the Tubbs Fire, part of the Northern California wildfires, caused over $7 billion in damages. The 2020 wildfire season was another record-breaking year, with over 4 million acres burned and insurance claims reaching new heights. The increasing frequency and severity of natural disasters can be attributed to several factors. 1. Climate change. Rising temperatures and prolonged droughts have made wildfires more intense and frequent. 2. Urban expansion. More people are moving into high-risk areas, increasing the potential for property damage. 3. Aging infrastructure. Older buildings and infrastructure are more susceptible to damage during natural disasters. To understand why State Farm and other insurers are pushing for rate hikes, we need to delve into the economics of insurance. Insurance companies operate on a model that requires them to collect enough in premiums to cover claims and operating expenses while still making a profit. When claims outpace premiums, insurers face financial strain. This is precisely what's happening in California. With the increasing frequency and severity of natural disasters, claims have surged, but premium rates have been kept in check by regulatory controls. In essence, insurers are caught in a squeeze. They can't raise rates to match the rising risk and costs, which threatens their profitability and sustainability. This isn't the first time insurers have threatened to leave a market. In the past, after catastrophic events like Hurricane Katrina, insurers pulled out of certain states or significantly reduced their coverage options. The result? Higher premiums and limited choices for consumers. Let's take a closer look at the economics of insurance. 1. Premium revenue. This is the primary income for insurance companies, collected from policyholders. 2. Claims payouts. This is the money paid out to policyholders for covered losses. 2. High claims reduce profitability. Reinsurance costs. Insurers often purchase reinsurance to protect against large losses. 3. Reinsurance costs have been rising, further straining finances. 4. Investment income. Insurers invest premium income to generate returns. 4. Low interest rates and market volatility can impact investment income. 5. Regulatory compliance. Compliance with state and federal regulations incurs costs and requires significant administrative resources. So what happens if State Farm decides to leave California? Let's explore the potential implications for homeowners. First, a major insurer leaving the market would reduce competition. Fewer options typically mean higher prices for consumers. Other insurance companies might also follow suit, further exacerbating the problem. Second, there could be coverage gaps. Homeowners may struggle to find affordable policies or any policies at all, particularly in high-risk areas prone to wildfires and earthquakes. Lastly, there's the broader economic impact. Higher insurance costs could make homeownership more expensive and less accessible, potentially slowing down the housing market and affecting property values. Let's delve deeper into these implications. 1. Higher premiums. Reduced competition often leads to higher premiums. 1. Homeowners might face significant increases in their insurance costs, which can strain household budgets. 2. Limited availability. In high-risk areas, finding insurance coverage might become challenging. 2. Insurers may become more selective, leading to coverage denials for some homeowners. 3. Increased risk exposure. Without adequate insurance, homeowners are more vulnerable to financial ruin in the event of a disaster. 3. This increased risk can lead to a sense of insecurity and stress. 4. Economic ripple effect. Higher insurance costs and limited availability can impact the broader economy. 4. Potential homebuyers might be deterred, leading to a slowdown in the housing market. 4. This can affect property values, local economies, and even state tax revenues. To get a deeper understanding of the implications, let's dive into some expert analysis. Experts in the field of insurance and economics highlight several key points that are crucial for understanding the situation. The insurance market in California is uniquely challenging due to the high risk of natural disasters. Regulatory measures like Proposition 103 were well-intentioned, but they didn't account for the increasing frequency and severity of these events. Experts suggest that the regulations, while protective of consumers, can sometimes prevent insurers from adjusting rates to keep up with rising risks and costs. Insurers need to be able to adjust their rates in response to changing risk profiles. Without this flexibility, they face significant financial strain, which could lead to market exits and reduced availability of coverage. This means that while regulations are necessary, they must also be adaptable to current realities to ensure the market remains viable. Additionally, experts point out that the government needs to find a balance. Protecting consumers is important, but so is ensuring that the market remains viable for insurers. This might involve reevaluating regulations and finding ways to mitigate risks more effectively. Solutions like state-backed insurance pools or increased investment in disaster mitigation could be part of the answer. Let's dive deeper into the regulatory impact. 1. Rate approval process. Proposition 103 requires insurers to go through a lengthy and complex approval process to adjust rates. 1. This can delay necessary adjustments and create financial strain for insurers. 2. Consumer advocacy. While consumer advocacy is important, it can sometimes lead to challenges in implementing necessary rate increases. 2. Insurers argue that they need more flexibility to respond to market conditions. 3. Risk-based pricing. Insurers advocate for risk-based pricing, where rates are adjusted based on the actual risk of insuring a property. 3. This approach can help ensure that premiums reflect the true cost of coverage and maintain financial stability. 4. Regulatory reforms. Experts suggest that regulatory reforms should focus on balancing consumer protection with market sustainability. 4. This might involve streamlining the rate approval process and allowing for more responsive rate adjustments. The ball is now in Governor Newsom's court. He faces a tough decision: maintain strict regulations to protect consumers, or allow rate hikes to keep insurers like State Farm in the state. If Newsom agrees to the rate hikes, homeowners might see their premiums go up, but they'll still have access to necessary coverage. If he doesn't, we could see a major shakeup in the insurance market with far-reaching consequences. This situation highlights the delicate balance between consumer protection and the financial viability of businesses. As Californians, it's crucial we stay informed and engaged, because decisions like these affect us all. Let's explore the potential government options in more detail. 1. Allow rate hikes. Allowing insurers to increase rates in response to rising costs and risks can help maintain market stability. 1. However, this approach might lead to higher premiums for consumers. 2. Strengthen mitigation efforts. Investing in disaster mitigation can reduce the overall risk and potentially lower insurance costs. 2. This includes measures like improved forest management, updated building codes, and enhanced infrastructure. 3. State-backed insurance pools. Creating a state-backed insurance pool for high-risk properties can provide coverage options for homeowners who might otherwise be left without. 3. This approach spreads the risk among multiple insurers and helps maintain market stability. 4. Regulatory reforms. Revisiting and reforming regulatory measures like Proposition 103 can help create a more adaptable and sustainable insurance market. 4. This might involve streamlining the rate approval process and allowing for more responsive rate adjustments. What are some potential solutions? One option is to revise Proposition 103 to allow for more flexibility in rate adjustments, especially in high-risk areas. Another is to invest in mitigation efforts to reduce the overall risk of natural disasters. Mitigation efforts could include improved forest management to reduce wildfire risk, updated building codes to make homes more earthquake-resistant, and better infrastructure to handle floods. Another potential solution is the creation of a state-backed insurance pool for high-risk properties. This would spread the risk among multiple insurers and provide coverage options for homeowners who might otherwise be left without. Let's take a closer look at some of these mitigation efforts. 1. Improved forest management. Implementing strategies to reduce wildfire risk, such as controlled burns, forest thinning, and creating defensible space around communities, can help minimize the damage caused by wildfires. 2. Updated building codes. Ensuring that homes are built or retrofitted to withstand earthquakes and other natural disasters can reduce the overall risk and potential damage. 2. This includes measures like seismic retrofitting, using fire-resistant materials, and improving structural integrity. 3. Enhanced infrastructure. Investing in infrastructure improvements, such as better flood control systems, can help mitigate the impact of natural disasters and reduce the risk of damage to homes and properties. State-backed insurance pools can provide a safety net for homeowners in high-risk areas. These pools spread the risk among multiple insurers and ensure that coverage remains available even in challenging markets. This approach can help maintain market stability and protect homeowners from being left without coverage. It's clear that there is a lot of work to be done and many factors to consider. The decisions made in the coming months will shape the future of California's insurance market and impact homeowners across the state. So what can homeowners do in the meantime? Here are a few steps you can take to protect yourself. 1. Review your policy. Make sure you understand your current coverage and any potential gaps. 2. Shop around. If your insurer leaves the market, compare policies from different providers to find the best coverage and rates. 3. Mitigate risks. Take steps to reduce the risk of damage to your home. 3. This could include creating defensible space around your property, installing fire-resistant materials, and retrofitting for earthquakes. 4. Stay informed. Keep up with news and updates on the situation. 4. Understanding the changes in the market will help you make informed decisions. Being proactive and prepared is key. While we can't control the decisions made by insurers or the government, we can take steps to protect ourselves and our homes. That's it for today's deep dive into the State Farm Ultimatum and its potential impact on California. If you found this video informative, please give it a thumbs up and subscribe to Cashegories for more insightful discussions on finance and economics. Also, let us know in the comments what you think about this situation. Should Governor Newsom allow the rate hikes, or should he stick to the current regulations? We want to hear your thoughts. Thanks for watching, and until next time, stay informed and stay savvy.